Choice of entity, taxation of income, problem 2. Mint, who is in the 37% tax bracket, is the sole shareholder of Herb Inc., which manufactures greeting cards. Herb's average annual net profit before deduction of Mint's salary is $370,000. For each of the following cases, compute the income tax burden. Assume all dividends are subject to a 20% tax rate. Ignore payroll tax. Mint's salary is $100,000 and Herb pays no dividends. Mint's salary is $100,000 and Herb distributes its after-tax income as a dividend. Herb is an S corporation. Mint's salary is $100,000 and Herb makes no distributions. Assume Herb's income qualifies for QBI or qualified business income deduction. Herb is an S corporation. Mint has no salary and Herb makes no distributions. Assume Herb's income qualifies for QBI deduction. Herb is an S corporation. Mint has no salary and Herb distributes all of its income to Mint. Assume Herb's income qualifies for QBI deduction. All right, this one's a long one. There's not really too much crazy going on. It's just keeping track of everything. So we've got, again, this individual Mint, 37% bracket. Keep all that in mind. You've got corporation, and we've got net profit of $370,000, and we've got basically different situations. And it's going to be choice of entity. We're comparing, contrasting. Of course, you've got income. Dividends are subject to a 20% rate. So the first variation, calling that variation 1, Mint salary, okay? And by the way, we're told in the original question that it's a corporation, and nothing in the facts tells us that it's an S corporation, so it's a C corporation. That's what we're told, unless the later number questions tell us differently. You'll see that in number 3, 4, and 5 that says now we're an S corporation. So just keep that in mind. So number 1, all these are asking what the income tax burden is. So what ultimately is paid by the corporation and shareholder together? That's basically what we're getting at. So now we're C corporation, double taxation, right? Cue the evil empire music. So in this situation, $370,000 in taxes before the reduction in the salary, $100,000 of salary, and then Herb pays no dividends, okay? So first thing we want to do is first level of tax is corporate level. So we want to take the $370,000, which is before the salary. We want to subtract away the $100,000 salary because that is deductible as a salary. Now, nothing here tells us it's not a reasonable amount, so we do assume it's reasonable. So there, we're going to get $270,000 of taxable income for the corporation. That's the taxable income of the corporation. So taxable income. Now I'm going to add an assumption here that's not stated in the facts, and that this will help us with our question. Let's assume, I'll put it in big letters, write this down. So we're going to assume, and by the way, if you're doing my class, if you're doing another teacher, you want to look at what the corporate tax rate is. You'll be told. But we're going to assume the corporate tax rate in this problem. So corporate tax rate equals 21%. Okay? I'm not saying to assume that all the time. I'm just telling you that we're going to make this assumption for this problem. I forgot to put it in the facts. Oops. Sorry about that. And then if you're taking my class, I'll tell you in the facts, assume a 21% corporate tax rate. I'll tell you that in the information. Okay, so just keep that in mind. Okay. So we multiply 270,000 by 21%. We're going to get $56,700. $56,700. Okay. That's the amount of tax the corporation pays. So tax corporation pays. All right, we're not done yet because that is just the corporate side of things. Now, there's no dividends, so there's not a second level tax. It just gets retained. Continues on. But there is a salary. Mint's salary is $100,000. So Mint is an individual. Mint has a $100,000 salary. We then multiply that by 37%, and that results in a $37,000 tax amount. Okay? $37,000 in taxes. So ultimately, total tax burden is going to be $56,700 plus $37,000. So the answer to variation 1 of total tax burden is going to be $93,700. That's the amount of tax burden in this one, $93,700. So that's all we're doing in these, okay? That's number 1. Number 1, simple as that. Okay, number 2. So Mint salary is $100,000. Herb distributes its after-tax income as a dividend. So this one's a little bit more involved. So here we basically start off with the same $56,700. That number is the same as from number one. So I'm just going to use anytime. So same as one. Same as number one for corporate tax. And that equals $56,700. Okay. Now, the $37,000 portion is also the same. Same as number one for individual salary. That equals $37,000. Okay, I'm going to put a line over here because we're going to need to add some numbers together. And then finally, we've got an additional item on this one, and that is we have to consider the tax on the dividend. We have to consider the tax on the dividend. The way we calculate this is we've got $270,000 taxable income after we consider the salary, okay? So we take the $270,000 of taxable income from the corporation. We subtract away the amount of tax on that $56,700, and that equals, I'll put a little equal sign over here, that's going to equal $213,300. $213,300, and that is the after-tax dividend. And then we multiply that by the 20% tax rate on dividends, which we're told in the problem. I know it's getting a little messy. I apologize. 20% tax rate, I'll put a little line. The good news is that for the S corporations, it's a lot cleaner. Okay? So we're going to have three different numbers here. We're going to have the $56,700 corporate tax plus the $37,000 plus we've got one more number, and that is $213,000 dividend times 20%. That number is going to equal $42,660. And that's the tax on the dividend. So $42,660. When we add those three numbers together, we're going to get $136,360. So $136,360. And that is the answer for our second variation. Again, the ultimately tax burden. So the idea is in the first question, mint salary, with no dividends, we've got C corporation tax and we've got tax on mint salary. That's it. There's no tax on dividend because it gets retained. On the second question, second variation, we've got mint salary that's going to be taxed. We've got the corporate tax on the $370,000 minus the $100,000 of salary, $270,000, and then we've got a tax on the distribution or dividend, all of whatever is left to mint. So you got three different taxes. So basically the question here is, okay, where is tax being paid? And then you add it all together. So ultimately the tax burden of all these parties, you add those all in. Okay, now the next three, which is variation 3, 4, and 5, we're now an S corporation. Makes it a lot easier because we don't have the double taxation anymore. Yay! So it makes it a lot simpler. So in variation 3, Herb is now an S corporation. So everything passes through. Mint salary is $100,000 and Herb makes no distributions. Assume that Herb's income qualifies for the QBI deduction. So we do get a QBI deduction for that amount. Now for all these different variations, let me put a line here. Let's make a line so we can make it very clear which ones, right? This is going to be variation 4 and 5. By the way, I'm numbering these because we're going to compare the numbers when we're all done, and we're going to see which one actually end up paying the most and which one you pay the least and where things are, how things work. So for all three variations going forward, that $270,000 amount is going to be important, okay, unless I tell you the salary changes. So this $270,000 corporate taxable income, that's going to continue, right? Remember that was $370,000, the net profit minus the $100,000 salary. That's going to be really important. So the idea here is if mint salary is still $100,000 and Herb makes no distributions, well, for an S corporation, distributions don't matter in terms of tax burden because you're allocated, right? You pay tax on the allocated income on paper. We saw that in previous problems. The idea is you have to pay tax on that whether you receive the cash or you don't receive the cash. Whether you, that's the system. That's the one level of tax. The idea here is, okay, you're paying $100,000 salary, so it reduces the $370,000 profit of the business, because again, that's before the deduction of the salary, to $270,000. So we've got the S corporation profit of $270,000. And what we're going to do is we're going to add all these together. And the reason why is because, remember, everything here flows through to the owner, and it's all going to be subject to the individual's ordinary income rates, because that's what it is, which is 37%, as we're told in the problem. This is $270,000 of ordinary income. That's why it's going to be subject to a 37% tax bracket. We also are going to have the salary, because now there's a $100,000 salary. So that's $100,000. And then in addition to that, we get to subtract, we get to subtract away the QBI portion, okay? The QBI deduction, qualified business income deduction, you've seen that in previous problems. That's where you get 20%. You get 20%, you get a deduct from the qualified business income. Now, the salary is not that component. The way we calculate the QBI is we basically take the amount, I'm sorry, I said the salary doesn't count. I meant the salary doesn't count in that you get to increase the QBI for that. You basically take the net profit of the business. That's another way to think of it. So the net profit here is going to be the $370,000 minus the $100,000 salary is $270,000, and you multiply that by 20%, which equals $54,000. So this number, $270,000 plus $100,000 minus $54,000, that formula, we're going to take that number and multiply that by Mint's 37% tax bracket, ordinary brackets. It's all ordinary income and benefits, and that deduction is a QBI deduction, QBID I call it. And when you calculate that, when you take $270,000 plus $100,000, $370,000, take $370,000 minus $54,000, and then that difference, multiply that by 37%, you're going to get $116,920 in taxes. Okay, you get $116,920 in taxes. So that was variation 3. Now we're in variation 4. Herb is an S corporation. Mint has no salary, so that $100,000 salary goes away, and Herb makes no distributions. Herb qualifies for the QBI deduction. So basically, we don't have a salary, so it's very similar to number 3. There's going to be differences to the S corp profit. The S corp profit is $370,000. Where am I getting that? Because $370,000 is before deduction, but now we're told there's no salary. So there's no deduction there. So we see that. And we're going to basically subtract away, because there's no salary tax portion, right, to take into account for Mint, just the QBI deduction. Now the QBI deduction, remember, is 20% of the net profit. So we take QBI, which is the net profit. And by the way, if you're wondering about the limitations, yes, there are certain limitations on qualified business income deduction. I've talked about those before. And in some problems, I tell you to assume that there are no QBI deductions. If you're not told in my problems to assume QBI deduction limitations apply, just ignore those. Just take 20% of the QBI, qualified business income. So the net profit here is just the S corp profit, which is the $370,000, right? Just the S corp, just this number right here. Multiply that by 20%, and that's going to give us $74,000 of QBI deduction. Okay, $74,000 of QBI deduction. So we take $370,000 minus $74,000. We multiply that by 37%, and we're going to get $109,520. And that's number 4. Finally, number 5, we have an S corporation. Mint has no salary, and Herb distributes all of its income to Mint. Assume Herb's income qualifies for QBI deduction. Well, if you remember from previous problems that we've done, when there's a distribution, it does not affect the amount of taxes that are due in terms of allocated income. Now, again, distributions for pass-through entities like partnerships and S corporations, they may have tax consequences, but that's not what we're asked here. We're asked about the consequences of the profit as well as the QBI deduction. So it's going to be the same result, the same 109,520 as number 4. Because the idea here is that there's no salary, so it's still going to be $370,000 of S corp profit. QBI deduction still stays $74,000, and distribution for an S corporation or partnership has no effect in terms of the ultimate tax owed on the profit generation. So that's why it's the same number. So it's the same 109,520. Again, a distribution can have consequences for S corporations and partnerships, but you're not looking at that here. You're looking at the effect of the profits and the various items. Here, no salary, just being paid out. Okay, so we've gone through everything now, and what you see is with the best situation here is the first one. We paid $93,700 in taxes where there's a $100,000 salary and no dividends paid out. Now, the issue there is ultimately you're going to pay out dividends eventually. And when you pay out those dividends, you're going to be subject to tax. So you can avoid the tax, especially depending on what kind of business you have, like an electronics business or a technology business. A lot of those businesses, they just keep retaining their earnings. And there's a way basically to avoid the accumulated earnings tax. It's another topic I talk about where you can avoid that second level of tax. Because there is an accumulated earnings tax, personal holding company tax that basically is put in place. Microsoft Corporation many years ago would not pay out dividends. It would just keep retaining its earnings to avoid the second level of tax to its owners. And then basically Congress put in a tax because it said no. Eventually, when you've got, billions or trillions of dollars of earnings built up, you got to pay out something. You're not just using all that money just to retain for technology. You just are doing it for tax avoidance. But technology businesses, they have a legit reason because of growth, R&D, research, those types of things. Okay? So the $93,700, that's the least here. But again, ultimately, sooner or later, when this business pays out money, it's going to have to pay tax on those distributions, those dividends. And as you see in number 2, that's the worst case, $136,360 when you have tax on the second level added in, considering the distribution of the items. Of course, you see the S corporation distribute. Even when you take a distribution, makes no difference, like we saw in number 4 and 5. So 109,520 is obviously between those two numbers, 93 and 136. But that's ultimately, end of the day, after everything is taken into account, getting you don't have a second level tax, anything in the future to worry about. Okay. Now there's also time value money. So if you hold out those the distribution for a while, it can give you benefits in time value money in terms of you can defer paying tax now and then wait till later, but you also have to worry about maybe tax rates could change, things like that. Okay. You also see in situation 3 that versus situation 4 and 5 that when we have a salary, we actually end up owing more in tax than if we don't have a salary and we just bring it all in. And the reason why that's the case is because you get a higher QBI deduction. So that's a special thing with the QBI deduction, a special issue there. You see that with the QBI deduction, a bigger benefit there. All right, so I hope you've enjoyed this one. I know this one's really long. Make sure you go back over this. The point of this question is to kind of show you different situations with C corporation and S corporation. Basically, C corporation, double taxation issues versus pass-through, because the partnership issues are going to be very similar. Of course, there's differences, partnership and S corporation, but just the pass-through of the items with income, you're going to see it's very similar here. So what I'm saying is that this was a partnership, would be very similar based on this situation versus if you had a C corporation, but the S corporation partnership issues will be very similar, especially given that those issues usually pop up more when there's losses and things like that.